We are on different topic now, or let me say
Yes, sir.
yes. So we are now on capital reduction.
And then you feel something feel big. No, no, they feel big.
So we are on capital reduction and business reorganization. Good. So under the capital reduction, please are you there?
Yes, sir. Sir, I'm
Good.
here with you.
That's good. So under the capital reduction, these are what you will be looking at. You look at what we actually call one, the capital reduction. Two, also look at reorganization. We look at reorganization, and the reorganization is where you will have what we call you will look at what we call maximum loss, right? And then you also look at also liquidation. In most cases, the maximum loss and liquidation works together. Most cases. I also look at we also look at what we call the merger or business takeover, or what you sent to me, the amalgamation. So these are the four areas we'll be looking at. The capital reduction will treat this one uh, as a stand separate. Then two and three will also be taken as a one subject area, and then four will also take as a what? As a one area. Okay. So now quickly let us look at the theory of when we say uh, capital reduction or business reorganization. What do we mean by that? Are you with me?
Yes, sir.
Okay, so when we say capital reduction or business reorganization, at which point do we say that a company has gotten to this point that we want to do capital reduction? Do you understand? So
Yes, sir.
when the company in its normal operation, the company is cash strapped, or the company is solvency, or the company doesn't have money to continue operating. So when that happens, the companies cannot pay its stakeholders and then shareholders. The company cannot pay dividend to the preference shareholders and ordinary shareholders. The company cannot pay its trade creditors. You understand? So when the company is into that situation, the best option is either the company go into capital reduction form, or the company do what we call liquidation, or the company decide that okay, they will allow themselves to be taken over by another company. You understand? So these are the options available for the company to take. Now, when the company find it self in that situation, they will not just go straight away or straightforward and say that okay, we are going to adapt this strategy and that is it. No, the company must go through what we call legal formalities. Well, remember the company is being governed by what? By law, right? Now, legal formalities, it means that one, company leadership must what? Or the board must what? Must meet. Please are you with me? So that's why we say they will organize something that we call extraordinary what meeting, right? Of maybe the shareholders and discuss. They will discuss and what? Do what we call approve the decision, approve the what? The scheme. Are you with me? Are you with
Yes,
me?
sir.
So they will organize this. You understand? Because when the company decides to go into have problem like this, before they take any decision, they have to meet. The board must meet to approve the scheme. Either they will go into liquidation, or either they will go what into capital reduction, or they will let another company to take over it. So before that, they have to meet and approve of that what decision in either of the scheme that they will adapt. Two, they must, so when they meet a high court, you understand, so they should seek approval from what? From the high court. They should seek what? Approval from what? From the high court. So because remember, if they don't follow this due process, somebody can disapprove of their decision to either liquidate. You understand? Because remember, once it is a public interest company, um, anybody can sue the company for a decision that are not legal. You understand? So when they meet and they agree that okay, we are adapting this scheme that you want to liquidate, then they have to go take it to what? High court for high court to approve it. Are you with me? So after the approval, what happened? Then they will seek they will tell the people involved. So the consent of what? Of other stakeholders. Please, are you here? So these are the three legal formalities that they will consider. Are you with me?
Yes, sir.
All right. So that is the three formalities they will consider. Okay, so after you've considered these, after you've understood the formalities and then the types of what schemes, now I'm coming to start with the first one. You understand? I'm coming to start with what? The first one. So the rest
Sir,
also, yes,
so in this case, like the legal formalities,
yeah.
how would ICA ask its question?
You will
Or
never
how would the
know. The
question
reason
look
why I
like?
just put it there so that you will never know. You will be there, panel that were 3 marks, 5 marks. You understand?
Thank you. Thank you.
All right. So let us look at the first one. Right. Let's look at the first one. The following the others will also follow the subsequent days to come. Let's look at the first
Thank
one,
you.
capital reduction. Now, when the company decide to settle on what or scheme on what capital reduction, what happens? Watch here. Capital reduction scheme. capital reduction school. Let me give you some of the summary of what you see. So that's the summary of accounting arrangement. So let me give you what you call summary. Summary of accounting arrangement of this. Now watch it. Example, like maybe one. If you have a capital reduction, right? And the capital reduction will affect capital. So that's what we say, maybe amount of capital written off. What does this mean? When you say amount of capital written off, what does it mean? When you are writing, example, if maybe a company A, I follow company A, share capital.
Okay.
Share capital is maybe the price of one cedi. So the total capital of this company is maybe 500,000. And they said that due to capital reduction, due to capital reduction, the shareholders have decided to what? Reduce their what? The share value. How much is the share value?
The share value.
Unit
One
share
times
value.
500,000.
Now the total share value 500. What is the share price?
One.
Good. One series, assuming. So because the company is what? Watch it. Because the company is in liquidation. I'm saying liquidation. The company is financial distress. Then they may decide that okay, we are going to consult our shareholders. You remember what I was saying? When the company want to what? Consider a scheme like capital reduction scheme, they will consult all the shareholders and then what stakeholders. You remember?
Yes.
Aha. So example, if they are consulting the ordinary shareholders and they say that okay, we have problem. So you should also do what we call sacrifice. Sacrifice. The shareholder will say that shareholders decide to reduce their share price to 80 pesos. What does this mean? What this means is that originally, this is their share capital. So the share capital, so this is their what? Their share is how much? 500.
100.
500,000. And then the share price is 1 cedi, right? Okay, when you multiply, what do you have? So the total value
500.
is 500,000, right? And now they have considered what? The company has now, what do you call it? Said the shareholder had decided that, oh, because the company has pleaded with us, they've pleaded with us that we should also consider, right? We should also consider to also sacrifice. So the sacrifice is what we are going to do is that we are going to reduce our what? Our unit share price
That price.
of 1
Yes.
cedi to what? 80 pesos. Have you seen that they've also what sacrificed how much? How much have they sacrificed?
0.2.
Thank you very much. Yeah, so you now realize that their new share value, their number of share is what? 500,000.
Yes, sir.
And the share price is now at what? 80 pesos.
That's right.
One no matter what do you have?
400,000.
400,000. Have you seen that? So have you seen the
Yes,
sacrifice
sir.
that they are making? Do you understand? the sacrifice that the shareholders are making. Are you with me? Is it a gain to the
Yes,
company
sir.
or loss to the company?
But they are making, this one will be, the shareholders are making loss, but the company is gaining.
Thank you very much. So that is what, so here, how much is the company gaining? So the sacrifice the
The company is
shareholders have
gaining
done.
100.
So the sacrifice the shareholders have done is a gain to what? Gain to the what? To the what? To the company. So that is where you will have what? The shares is how much? 500,000. And then the price that they gain is how much? 0.2. When you multiply that, that gives you what? 100,000, right?
100,000. Yes, sir.
Now, so because this very gain that the company had is what we call, will go where we call what? Capital what? Reduction account.
This one, okay.
You understand? Because somebody is gaining and somebody is losing. So this is what will go to what? Capital reduction account. Please, do you understand?
Yes, I'm getting it small.
Good. So here, so that is where, when you, since you understood, you just understood this one, this is where the ledgers. Do you understand? So what we've done here,
Yes.
have you seen that we've done here? All that we've done here, then you put it in the ledger form. So how do we put
Okay.
it? How do we put it in the ledger form? So all you have to do is that you what? You will have your what? Your capital account. So this is your capital account. And our capital account, you have what? Debit and credit, right?
Yes, sir.
You can bring it all here, or you can make it T form. So here you have your what? Your debit here, and you have what? Your credit here, right?
Debit, yeah.
Don't forget about that. So now once you have it here, you will see that you know that share capital has what? Credit balance, right? You know
Yes,
that.
sir.
So that's where you have your what? Your opening balance. So the balance brought down earlier. The balance brought down was what? 500,000. Have you seen that? And the company
Yes.
and the shareholders decided that they will sacrifice how much?
The shareholders are sacrificing 100,000.
Thank you very much. So that is where you will come and do that sacrifice that they make is again to the company, and that is what we call what? Capital reduction. Capital reduction. You understand? That sacrifice that they
Yes.
made is what we call, it will go to capital reduction account. So you debit what do you call, so it will go to capital reduction. So that is where, when we did the calculation, we pick the 500, multiply by what? Multiply by
The
2%.
0.2.
So that gives you what? 100,000. So whatever is left is what? Your balance carried down. The balance carried down was 400,000. You understand? At least you
Yes, sir.
understand. Then your account is loose like that. So that gives you here is 500,000. Yes, what? 500,000. Then you are done with this one. You understand? So here, this is how you do the ledgers. So when I'm doing the capital reductions, you do the ledgers like what you've seen here. You open the ledgers like this.
Okay.
You understand? You open the ledgers like this. So you realize that when you are done and you are taking it to your balance sheet, you take all the carry downs to the balance sheet, because now your new capital value or share capital is 400,000. So you have it as what? Balance brought down, which is what? 400,000. I believe you are following.
Yes, sir.
This is how capital reduction is done. You understand? So by then you had already opened your capital reduction account. Capital reduction account is already open. That one also has debit and credit. So any gain or losses will come here. You see the whole thing. Any gain or losses will come here. So have you seen that the assets, the share capital, there's a gain there. Have you seen that? There's a gain of how much?
100.
It is debit or credit.
Here it is debit.
Good. So when whatever is a debit in that ledger account, you bring it at what credit, uh, credit side of what of the ledger of the capital reduction account. You understand? So here you have what your share capital, which is what 100,000. Do you understand this? Okay.
Yes, sir.
Good. Then let us come to 2.
Sir, let's go up somewhere. Let me see something. The ledger side. Sir, this is capital. It's capital account.
Yeah, share capital.
Okay, share capital. Let me go there. Thank you.
All right. So let us
share capital. Thank you.
Let's take another one as what income surplus. Now, if you don't see income surplus and you see retained earnings, they are the same thing. Now, income surplus or retained earnings written off. What does it mean? Income surplus or retained earnings written off. Their ledger is what? Debit what? Capital reduction account. And then what? Credit what? Income surplus. Now, what this one means is that when you open your what statement of what financial position, that is where you will find it. Now, this one you will find it under equity of what of the company. So under the equity, you will have your what? You have your what? Your share capital, maybe 500,000. That one you have what? Debit, and you have what? Credit. And you know, and we all know that equity capital has what? Credit balance.
Yes, sir.
Good. Now, example, if you have what income surplus. Remember, I said that if you don't see income surplus, you see what?
Retain earnings.
Good. Now watch me here. You are doing capital reduction. Surely they will bring you income surplus or retained earnings. Now, income surplus, when a company is what? Is cash strapped. Are you listening? When the company is in cash strapped, it means that the company has been making losses consistently, or the company has been making losses over the period. Are you with me? So if the company is not making losses over the period, then the company is not bringing in any money. Do you understand? So if the company is not bringing in any money, then there is no income there to do what? To call surplus. Are you with me? There wouldn't be any income to call surplus because there are losses that it is coming in. Right? So you will see that. So you see that example, the income surplus. The income surplus, assuming it is positive figure, you will see it here. You will see it at the credit side. But if it is what? Because it is what? It is a consistent loss or not making profit, it will be at the what? At the debit side, maybe 20,000. But what I say, you understand this?
Yes, sir.
You will see at the debit side in your statement of financial position. Because there's no way you are doing capital reduction. They tell you the company is what? Is in the debt, is in distress for you to see any income surplus, which is positive. It is always what? Negative. So when you are in a statement of financial position in the question, you'll see that equities, all of them will be at the credit side, but the only income surplus or retained earnings will be at the debit side. So you should understand this. Are you with me? Now, if you don't find it, if they didn't present the accounting statement like this, and they make it like this, you will see that income surplus will be in brackets. Are you with me?
Yes, sir.
Now, that is why we say that the moment you see income surplus like this, all that you have to do is that open the ledger account for that. So you will have income surplus account. That one to you underline. You have your credit here. You have your debit here. Income surplus, watch here. Income surplus is supposed to have credit balance, but when you look at it, have you seen that the balance is at the what? At where?
It's at the credit side, but it's negative.
It's negative,
It's
so it means it is at the debit side. No. So you have your balance brought down for 200,000. Are you following?
Yes, sir.
So here they said that you have to write
So
it off.
is it 200,000 or 20,000?
20,000.
Yes.
I'm
following keenly.
You see, so because it is it's here, I will say it's in bracket, it means it's the debit. You understand? Okay. Because all equity items are what? They are all credit balances.
Credit.
You understand? And I'm telling you that in the question, they can do what you call your balance sheet like this. So since this one is is negative, or is is a loss, so they will bring it at the debit side like this. So you should understand what it stands for. You understand?
Thank you.
Good. Now, when that happens, and you open the ledger of income surplus like this, it will go to the to the debit side. So when you go to the debit side, the standard says that you should write it off. It means you should remove it. So this one you go to capital reduction account straight away. So who is losing?
At this juncture, we know that the company is
losing. So the company is losing. So you write it off. It means they are removing it from the books. So when they open new balance sheet, you will not see income surplus there. Do you understand?
Yes, sir.
So you see that this one will go to the capital reduction account. Since this one has capital reduction is at the credit side, where will it go in the capital reduction account?
Debit, sir.
Good. So you come here, then you say that income surplus 20,000. Do you understand this?
Yes, sir.
Good. Now let's go to the third example. Maybe if you have asset to be written off. Okay, asset to be written off. All you have to do is that you debit capital reduction account depending. Then you credit your credit asset. Now watch here. At which point do we see that debit capital reduction and credit assets? This is a situation example. If you have maybe PP, carrying amount, 40,000, right? Now,
Yes, sir.
the company did the valuation. Since they are considering a scheme, the company decided to value all its assets. So they did what we call revaluation of assets. And then they have PPA. They revalue the PPA. And when they did the revalue, the PPA now is 30,000. When that happens, when you are confirmed like this, the next thing that you have to do is you prepare the ledger. So the ledger, you bring your asset, whichever the asset it is. So you have your asset account. So you have your debit and you have your credit. Now let me ask you, PPE or asset, which balance does it have?
PPE. PPE is a debit item.
So you have your PPE, also your balance brought down. PPE, it was 40,000. Do you understand?
Yes, sir.
Now, after they did the revaluation of this PPE, so that one you will bring it at the credit side when you are doing this. Huh?
Yes, sir.
So when you are doing it, you will bring it to the opposite. So revaluation of the asset. How much is the revaluation of the asset? 30,000.
30,000.
So here, has the asset gained in value or it has reduced in value?
The current amount is 40,000. Now, when it was revalued, it's 30,000. It has lost in value.
So that is also the difference. So the difference will go where?
The difference is 10.
It will go
This
where?
revaluation
Is the debit side or credit side?
since OCI, then the
I'm saying
credit
that
side.
the difference will go to debit side or credit side. The difference here is 40,000. Here is 30,000. We
go
are
to the
balancing
credit
it.
side.
Aha.
Credit side.
So if so, which value is bigger? 40,000 is bigger. So you close it here like
That will
this.
be the closing.
Now, so the difference will go what we call capital reduction account. What is how much? 10,000.
10,000.
So here, is the company gaining or losing?
If it is credit, it's a gain.
I'm saying the company losing or gaining?
Although for the company, he is losing.
The company is losing because the asset has lost in value. So since
Value,
So here it's simple. Wherever you see the capital reduction, the opposite will go to the capital reduction account. Simple. So here you see that the capital reduction is at the credit side. So when you go to the capital reduction account, you see that
it will be at the debit
it
side.
will be at the debit side. So yeah, this one is assets or PP, which is 10,000. Right? Okay. So that is another example.
Thank you.
Then you pick another fourth one. We also have maybe conversion of loans or
No,
something.
is there? Oh, okay.
Conversion of loans.
Okay. Asset written down. Okay, 4 is true.
Or debentures.
Thank you. Thank you, sir.
Debentures into shares. Now watch here. Another one here. We said that debit was
The
loan.
conversion of what?
Conversion of loans or debentures into shares. Debit
Thank you.
loans account and your credit ordinary shareholders. Okay. Here is the situation. What they mean here is that assuming you have 20% debentures, 100,000. Debenture holders agree to convert 60,000 of their loans into what? Into shares. So this is what they are saying. So here you have the venture holders. The venture holders, their company is in distress, and they said that okay, this is your total shares that you total debentures that you have, and we want you to also we want to also sacrifice for us. Do you understand? So the sacrifice is that we want you to convert
Yes, sir.
out of 100,000. We want you to convert 60,000 of your shares of your loan into what? Into shares, so that you become what? You become ordinary shareholders of what? Of the
Shareholder.
company. So
Yes,
here,
boss.
good. So here, this is how it's going to happen. So follow me here. One will
Thank you.
say the total offensive shares no volume the total debentures no 100,000,
Debenture.
right? 100,000. And they say that
Thousand.
they
Yes,
should
sir.
take 60,000 of that 100,000 ordinary to become ordinary shareholders. So here your ledgers are going to be like this. One, you open what? 20% debenture account, which is what? Credit here and debit here. Debentures,
Very good. Yes, sir.
debentures which do they have uh balance, or what is their balance? Debit or credit balance?
Or to be credit is a liability.
Thank you. So you have your what? Your opening to balance brought down 100,000, right? Do you understand?
Yes, sir.
Good.
Yes, sir.
Then you also open. So they said that they will forfeit 60,000 of their money. And yes, sir.
Yes. To
Some
become
countries
ordinary.
they should give
Yes,
you
sir.
60,000. So here, so if they are giving in their money of 60,000, then you come and credit it. So they said when they will forfeit the 60,000 to become what? That money is going to where?
Shareholders, sir.
Thank you very much. So if they are going, so then they become share capital. So debit side will what? Share capital. Share capital, which is what? 60,000. You understand? So here, then you have to come and also open share capital account here. That one too, you have what? Your credit here, and you have what? Your debit here. Assuming, let us use the share capital I use above. So assuming I have the balance, shares also have what? Credit balance, right? So balance
Yes,
brought
sir.
down. Maybe the share capital is maybe 400,000. And now they said that the venture holders, they want to convert the venture holders to become ordinary shareholders. So all you have to do is that how much are they converting it to become ordinary shareholders? 60,000. So all you
60.
have to do is that
60.
you debit your the venture holders to reduce their debenture value. Do you understand? You debit
Yes,
it
sir.
to reduce their debenture value. Then you credit what? Your credit share capital of what? Because now this money is now coming to share capital to increase the share capital. Do you understand? So which account is that? Is what? Is 20% what? Debenture,
Debenture.
which is how much? 60,000.
60,000.
When you are done, then you close the account. So here you will have what? Your balance CD will be what? Here will be what? Will be 40,000. So here to what? You close the account here. So you realize that your new 20% debenture is now how much? So balance brought down will be 40,000. And here, when you add this one, your balance brought down will be 460,000. And you close the account like that.
So I'm coming over.
What is the issue?
Oh no, I'm writing smart, so
Now nobody is losing here, nobody is gaining here. Have you seen it?
yes.
So here there's nothing like capital reduction. Only capital reduction comes in when there's a gain or there's loss. You understand?
Yes.
Here there's no gain,
That's
there's
it.
no loss. So it's between two accounts. Then you balance it for.
Let's go on.
So here the fifth one, maybe we have maybe preference shareholders. So preference shareholders
Accepting, eh?
yes, accepting ordinary shares. So here, when they accept, what happens? All you have to do, you debit what preference shares, then you credit what ordinary shares. Now, example, if in the question they said that you have maybe 15% preference shares, which is 50,000. The preference shareholders, agree to 40% of their shares to become ordinary shareholders. So here, when that happens, what do you do? First, you open ledgers. So the ledger that you open what? 15% preference shareholders. You have what? You have a credit, you have your debit. Preference shareholders, what is the account the balances where credit or debit?
It's still credit,
So you have
sir.
your balance brought down, which is 50,000. And they agree that out of 50,000, they want to convert 40% of this 50,000 to become ordinary shareholders. But what I said, that is the question.
Yes, sir.
So when that happens, all you have to do, you credit their or you debit their account by 40,000. So here,
To reduce.
and it will go where it will go to ordinary shareholders. Ordinary shares. So they said 40% of 50,000. How much is that?
40% of 50,000.
Yes.
50,000. Sir, 20,000, sir.
20,000. Remember,
Yes, sir.
this 40%, they are taking 40% of 50,000 to become ordinary shareholders, which is how much?
20,000,
So
sir.
that will be 20,000 here. Now, the corresponding entry is what? Share capital. Well, they are converting it to become ordinary shareholders. So you have your credit and you have your debit here. So here you have your what? Your balance brought down of what? Of capital of what? 460,000. So here you have what? Then you credit. So this one is what? Preference shareholders.
The first one is what?
Which one?
The first one that you wrote, 40 is here. Stated share capital.
460,000.
No, the word before the 460,000.
Balance brought down.
Thank you.
So yeah, your preference shares will what? Will be 20,000 here. They are adding 20,000 here. You understand? So yeah, you realize that when you are closing the balance, here will be what? You have for closing balance of what? Balance carried down, here will be what? 30,000. Then you close the account by what? 50,000 there. Then account will also be what? Will be close 50,000. The same applies to this one. So here you have what? 480,000.
Okay.
Balance CD 480,000. Okay, so that is it about this one also. So you see, you realize that this one there's nothing like capital reduction. Roger, what you saying?
Yes.
There's nothing like
Not
capital
really much.
reduction because it is transaction between two accounts. Nobody's losing, nobody's gaining. So now another one is maybe issues of shares. Now it's simple. Yeah, you debit what? You debit cash or bank. Then you credit what? Share capital. Simple. You understand? I don't need to be clear. So when new share is issued, what do? You are receiving money, and then the share capital will also increase in value.
Yes, yes.
Good. The seventh one is reorganization expenses. Reorganization expenses. So reorganization expenses, that one too is straightforward. The company is what? Is going to pay. Are you with me? The company is going
Yes.
to pay the what? The resource person or the one who is going to liquidate for the administration of what? Of the company. So the company is going to lose. Do you understand? Money for that work.
Yes.
So when that happens, then you debit what? The capital reduction what account. Because remember, anything that goes to any item that goes to the debit side of capital reduction account is what? It's a loss to the company. You understand? Anything that goes to the debit
Yes,
side of
sir.
capital reduction is a loss to the company. Anything that goes to the credit side of capital reduction is a gain to the company. So the reason why the reorganization expenses is what is debited because the company is going to lose. Then you credit your what? Your bank or what? Or your cash. Because you are going to pay it will reduce your what? Your resources. Do you understand?
Yes, sir.
Yeah,
The bank is paid.
so far, this is what the brief summary of what capital reduction. Brief
Action.
summary of capital reduction. Brief summary of capital reduction. Any question, please?
No, sir.
Come again, sir.
No, sir.
Thank you very much.